Ladies and gentlemen, welcome. This is again our 4ST441 Statistical Methods and Capital Markets. Today we have in front of us the 8th seminar of this subject. So I hope that everything is ready. We can start. As you can see, today we will speak about volatility. We will explain what is it volatility. Yes. Here we have a question: why is studying volatility so important? Yes. Important for pricing options. Important for calculating value at risk. Improving efficiency. In parameter estimation and the accuracy of interval forecast. Yes, volatility is also the changing, the development of changing of variance in the time. Yes, we will see on the real examples. That in some case we have a small volatility, the small fluctuation, the small variance in time, and in case of, for example, crisis, changing of the political development, political situation, changing of the macroeconomic cycles, etc., you can observe a significant changing of volatility. Yes, volatility, the definition, yes, volatility is the conditional standard deviation or variance. Yes, standard deviation or variance, we know that the standard deviation is the square root from the variance. Yes, so conditional standard deviation or variance of future log return conditioned on the current available information, such as the history of log returns. Yes, a time series model of the time series has to be specified so that volatility at a future time t can be estimated from the historical information, historical log returns. Yes. Examples of such models are classified or denoted ARG and GARG. It means auto-regressive conditional heteroscenasticity or generalized. Yes, generalized auto-regressive conditional heteroscenasticity models. So this is important, and remember mainly this title information as that volatility is the conditional standard deviation or variance of the future log return conditioned on the current available information. Yes. Okay, we can continue. Volatility is not constant over time. Yes. Mainly. When you see in the future the models about I already talked, ARG and GARG, yes, you will see that these models are based, yes, on the modeling of squared values, yes, squared values. Because of compatibility with the variance and with the meaning of the volatility. Yes, so volatility is not constant over time, and mainly if we model the time series of anything, yes, log returns, stock prices, or development of other macroeconomic indicators, yes, it doesn't matter. But if we model this time series in squared values, yes, you can see and you can expect, yes, that significant changes, significant differences, absolute differences are in squares very, very large, yes, and there you will see very large, very significant change in volatility in the time if we model everything in squares, yes. First important thing is that everything in squares is non-negative. Yes, so everything is above the zero axis, non-negative values only. Yes, 0 squared is 0, but minus 3 squared is plus 9. Yes, minus 10 squared is 100, plus 100. Yes, so squared values are large values mainly if the differences, absolute differences, are higher and higher, as the square differences increase very significantly, yes, and we are modeling, yes, we model only non-negative values, non-negative entirely. So the volatility is not constant over time, we know this. It tends to increase during, and this is important, maybe remember that I already touched this information. It tends to increase during political, financial, and economic crisis, as the changing of political situation, changing of governments, as financial crisis, economic crisis caused by any other situations, yes, and decrease during calm periods. Yes, so if we have a development of calm period without political situation changing, without political election, yes, etc. This volatility is calm. Yes, so it's very important. Volatility is influenced by economy, inflation, industrial production, now coronavirus pandemic, etc. Yes, so the macroeconomic processes, the situation in the country, not only in the country but in the world, yes, influence the volatility. Yes, volatility is mean reverting. There are periods of high volatility followed by periods of low volatility. Yes, so if you check the development, yes, of some real-time series, mainly if you compare the period where nothing happened in economy, in political situation, in world, yes, and if you compare this with the development where these changes were significant, yes, you can see there are periods of high volatility with periods of low volatility, or in different order, yes, low volatility and after high volatility, yes. Okay. This phenomenon is called volatility clustering, yes, because in some cases and for the purposes of some application, it's good to cluster, yes, to divide the time series, the development of time series to groups, to clusters, yes, the cluster with significant high volatility and model this period separately, yes, and the cluster, the period with low volatility, and model this this period again separately, yes, and after we can connect these models, yes, the results based on these models, etc. Yes, it's possible. This is possible. High volatility is usually associated with a high trading volume. Okay, so we will continue and we'll speak about modeling of logarithms. Yes, we talked about prices, stock prices, calculated logarithms, yes, and we talked about other financial and economical time series. Now about logarithms again. What model for logarithms is capable of explaining many observed characteristics of volatility as well as the major facts for logarithms. we used ARMA before, yes? Do you remember ARMA model with orders parameters P, with orders Q, yes? The connection of auto-regressive and moving averages, yes? The linear dependence in time series of log returns is often very weak, if any at all. Do you remember when we calculated, yes, estimated autoregressive model, moving average model, or ARMA in general, yes, on the real data? We estimated these models, we had parameter phi equal to 0.3, 0.11, 0.4, so weak, yes. Also the theta was also weak, yes. We, after calculated the forecasts, yes, the prediction based on this optimal model, the model which we found on the basis of the real data, and you could see that we were able to forecast 1 future value, 2 future values, 3 future values, and that's all, yes. We forecasted very small number of potential future values, and after the forecast was the mean, the conditional mean only, the line, yes. So we were not able to forecast the time series of log returns, of stock prices, etc. Yes. The memory was small. Memory was small inside this time series, and the parameters were weak. Yes, there was not enough information for the modeling and for the potential forecasting. Yes, so this sentence is very important. Moreover, the mean of log returns is often orders of magnitudes lower than the standard deviation of log returns. This is connected also with the sentences. Therefore, we use special models, ARC and GARC, yes, autoregressive, conditional, heteroscenasticical, or generalized models. Yes, in general, this autoregressive, conditional, heteroscenasticity. Okay, so modeling of returns, we can often reduce the general ARMA P and Q model for log returns RT in this form. You remember this, yes? The logarithms of returns, logarithm in time t is equal to, please check this part, yes? This part is general autoregressive model, yes? General autoregressive, phi zero constant, intercept, yes? Which can be placed in the model or is removed if it's not statistically significant, yes? Phi 1 r in time t minus 1, phi 2 r in time t minus 2, phi 3 r in time t minus 3, etc. Yes, plus AT, yes, the Gaussian white noise, plus, and there starts the moving average part. Yes, you remember theta 1 a in time t minus 1, theta 2 a in time t minus 2, theta 3 a in time t minus 3 until phi and theta q a in time t minus q. Yes, okay, where RT in the case of autoregressive conditional heteroscenasticity, yes, is HT powered by 1 divided by 2. What is it? It's a square root from HT. Yes, HT powered by 1 divided by 2 is square root from HT. Yes, times ET. Here, HT is the conditional variance for time t, conditional information available at time t minus 1. Yes, so you can see that there is a connection with autoregressive models. Yes, again, we are using on time t, we are using some information from time t minus 1. Yes, Et is often assumed to be Gaussian white noise with unit variance. Yes, so you can see here a small connection, yes, with ARMA or auto-regressive models. Yes. Okay. Before we start with ARC models, yes, in general, I will finish very important issue, and this issue was diagnostic tests. Diagnostic tests of residual component. We already talked about Young-Box Q test for autocorrelation. Do you remember correlograms? Yes. The development of autocorrelation function, partial autocorrelation function, and Young-Box Q statistics. Yes. The test for autocorrelation, the correlation of the values of non-systematical error component or other analyzed values. Yes, Young-Box Q tests, and the base of this Young-Box Q test was zero hypothesis. There is no correlation. There is no correlation. There is no autocorrelation. There is no dependence in the data set. Yes, alternative hypothesis. There is a dependence. If the zero hypothesis was rejected, no autocorrelation, we had correlation. Yes, and in the case of residual component, this is wrong. Yes, it's necessary to not reject zero hypothesis. Yes, in the case of normality testing, you remember that I already showed to you Jarque-Bera test of normality. Yes, Jarque-Bera test of normality, which was chi-square goodness of fit test, the type, special type of chi-square goodness of fit test. Yes, and on the basis of this fitting, yes, we compared empirical values, empirical distribution of the data, for example, the development of error component, yes, with theoretical, with expected component, yes, how this component will look like if this distribution is normal, yes. So again, the zero hypothesis was normality. Yes, normality, the data is normally distributed. This was our zero hypothesis, and our wish was to not reject the zero hypothesis. Yes, so we have here Young-Box Q test for autocorrelation, or Darwin-Watson, if you remember, as well. Yes. We have here Jarque-Bera test for normality, yes, and we will speak now about Broch-Godfrey ARC test, which is a test for testing of homoscedasticity, primarily based on the residual error component. Yes, and we did not speak about this test before. Yes, so now I will speak about this test, because you can see here these letters are autoregressive, conditional, heteroscedasticity. Yes. So now about this test, which was based by authors Broch and Godfrey, and in the future prepared in a little bit different way, advanced way by Broch, Pagan, Godfrey. Yes, Broch, Mr. Pagan and Mr. Godfrey. Autoregressive conditional heteroscedasticity, in the shortcut ARC effect test. Yes, We know that most linear models and time series models estimated by ordinary least squares method assume homoscedastic disturbances. It's necessary to test the residual error component on the basis of autocorrelation test, a heteroscenasticity test, and normality test. Heteroscenasticity is most expected in cross-sectional data, but it's also present in financial time series. Why? Because of the development of these time series. We already talked about calm periods. We already talked about the periods with significant changing of development, political situation, macroeconomic crisis, etc. And this change in the development causes to change of volatility, the amplitude in development in the data, and this non-constant development of variance in the time causes to heteroscenasticity. Null hypothesis assumes that all variances are equal in time. Null hypothesis in the case of arc test is that there is homoscedasticity. Variances in time are equal. Equality of all variances in the time. Homoscedasticity means equal variance and finite variance in time. Equal and finite variance. Very, very important characteristic. So, null hypothesis is homoscedasticity, and as well, like in the case of autocorrelation test. In the case of autocorrelation test, null hypothesis is there is no autocorrelation. And our wish is to not reject zero hypothesis. In the case of normality test, the zero hypothesis is normality, and again we require to not reject the zero hypothesis. And in the same way, this is another diagnostic test, and the zero hypothesis homoscedasticity. Our wish is to not reject this zero hypothesis. Alternative hypothesis for any variance, for any case of variance, is this variance different? And this is heteroscenasticity, and this is a problem. So, in the case of model and diagnostic of residual error component, we require homoscedasticity, no autocorrelation, and normality. And before I'll show to you arc model, which is designed on the modeling of volatility. We will start with this arc test because this is programmed, this is implemented in EU software, and we will check how the authors designed this test, which is based on artificial regression of the residual component. But before we start to create the model, and evaluate the residual component, where we will talk about arc tests, and where we check the regression model, the artificial regression model created on this residual component. We will speak about one important issue about which I already talked a few weeks ago, and this is issue about information criteria. Information criteria are used in the case that we would like to evaluate more models, yes, more models between them, more models modeling the same thing, the same data set, the same time series, yes. And I already said to you important information that these information criteria are based on penalization technique, yes. You, like a statistician, are penalized in the case that you do something wrongly, yes. So, in these future slides, yes, I will speak about these information criteria a little bit more, because we already know, yes, that it's necessary to evaluate the residual component in the case that we create models, and if we have more models, yes, we would like to select the best one, and the best one is not selected only on the basis of, for example, adjusted R squared, yes, but in the case of statistical modeling, on the basis of information criteria. So, information criteria are measures for selecting and comparing various models, yes. Information criteria are used to compare alternative models fitted to the same data set, yes, the same time series, the same sample size, yes. Measure of the quality of a statistical model. It's a number, yes. Information criteria, it's a number, it's a statistic, yes, and the value of this statistic is important for you like statistician, for evaluation of correctly selected model, yes. Information criteria take into account, for example, how well the model fits the data and the complexity of the model, yes. Smaller values indicate better models, and now the very important issue which I already told to you, smaller values are better values, and this means that minus 10 is better, is smaller than minus 8, yes, because these information criteria, yes, can reach any value, yes, either positive or negative, yes. So plus 100 and plus 120, yeah, the smaller value is plus 100. So if we have the value plus 100, it's better, yes. But if the values, the results of information criteria are negative, yes, it depends on the data set, yes, it depends on the character of data set. So if we have negative values of information criteria, the smaller value is the more negative value, yes. Minus 20 is better than minus 50, etc. Yes. Okay, information criteria are computed as, and there we have a general formula for information criteria, IC, equal to 2k minus p times logarithm of likelihood. Where you can see k is the number of parameters. K is the number of parameters of the model, yes. P is a penalty factor, yes, and logarithm of L is log likelihood, logarithm of likelihood ratio. Yes, so this is a general formula for information criteria. And other authors, other statisticians, yes, modified this formula to specialize information criteria, and we will speak about 3 most important information criteria which are programmed in many statistical softwares. as I already said, we have more information criteria prepared in econometric software or software for analyzing of time series. The first and probably the well-known is AKK information criterion with the shortcut AIC. It adjusts the two restricted log likelihood by twice the number of parameters in the model. Employs a penalty factor of 2. This is formula for calculation of AKK information criterion. AKK is equal to 2 times k minus 2 times logarithms of likelihood. So this is the first and probably the most known information criteria. I already talked about Schwarz information criterion. You maybe know that Mr. Schwarz Gideon was a Bayesian statistician, and I probably already said that in some software is this information criterion called BIC, Bayesian information criterion. In other software, this criterion is denoted like Schwarz information criterion SIC. Yes. So this Schwarz Bayesian information criterion has a stronger penalty than AKK information criterion for over-parameterized models and adjusts the -2 restricted log likelihood by the number of parameters times the log of the number of cases. So if we check this formula, you can see reference in comparison with AKK information criterion. Bayesian information criterion is equal to 2 times k minus logarithms of n times logarithms of L. N is the sample size and L is likelihood, logarithm of likelihood ratio. And the last is Hanan Quinn, the last which is programmed many times in many other statistical software. Hanan Quinn information criterion also employs the number of observations, sample size as n, and the formula for the Hanan Quinn information criterion is calculated like 2 times k times logarithm, where we have here logarithm of n, so logarithm from logarithm of n minus 2 times logarithm of likelihood, logarithm of likelihood ratio. Okay, now, because we already know what is it auto-regressive conditional heteroscedasticity and what is it auto-regressive conditional heteroscedasticity test, Brugsch-Godfrey, and information criterion. We have here exercise 28. We will use any available time series where we have calculated logarithms. Yes? So on the basis of real data, we will use data set where we already calculated logarithms. So I don't know, we have for example Microsoft, Amazon, Boeing, etc. We'll establish optimal ARMA model and we'll use Brugsch-Godfrey ARC test to identify whether the non-systematical error component does not contain heteroscedasticity. So we will establish some model, yes, and I will show to you this ARC test in EU software, as well as Jargon test for normality and Box Q test for autocorrelation. So today I will show to you these three tests together, yes, and mainly I will show to you the artificial regression of Bruch-Godfrey R test, where you will see the regression model of R, of this autoregressive conditional heteroscedasticity. We will check the parameters. Yes, and I will say to you the formula which is estimated in the case of this artificial regression model. I said that we will use the real time series, yes, and on the previous seminar we have here three real data sets, yes, if you remember, about Boeing company, Amazon company, and Microsoft company, and we try to estimate here some models, and you could see that these models were not so significant, yes. The parameters of these models were weak, and we were not able to predict a lot of observations to the future. So I opened, for example, stock prices of Amazon company. There's one of the model from the previous seminar where we were able to calculate a forecast. Yes, you can see that we have here already calculated log returns of Amazon company. And today I will create this model one more time. Yes, I hope that I remember this correctly, that it was only autoregressive model of the first order, yes, with quite weak parameter phi, yes. We will establish this model one more time, and we will perform all three diagnostic tests, yes, on the diagnosis of residual components. So please double click on log returns Amazon, yes, and I have here saved, yes, autocorrelation and the partial autocorrelation function, the correlograms. Yes. If you cannot see this image, yes, you can click on View button here. You can click on correlogram, yes, correlogram of level, okay, and you will see this chart, yes. And you can see that autocorrelation coefficient or partial autocorrelation coefficient is only 0.14, so very weak, yes, very weak. And we established AR1 model without constant, yes, because these log returns fluctuate around the zero value, so the constant is not statistically significant, yes. So please, we will click on quick button, yes, we will use estimate equation, and we will write here the equation of our model. So it will be log rit Amazon space and only AR1, yes, autoregressive model of the first order. At home, because you have probably the latest version of EView software, it's necessary to click on options button and select here, instead of maximum likelihood method, least squares, and the method of least squares. Okay, so we will estimate this model, okay, and you will see here variable AR1, yes, very weak coefficient phi, minus 0.13, statistically significant at the 5% significance level, as Darwin-Watson close to 1.97, yes, and this model was used on previous seminar for calculation of forecast. As if you check our forecast from previous week, you will see that we were able to predict only 2 or 3 values, and after the prediction was the conditional mean, yes. Okay, so this is the model, and we talked about autoregressive conditional heteroscedasticity, and in general we talked about heteroscedasticity, yes, about the changing of variance in time, yes. We will check the development of this residual series, residual component, the residual component calculated from this model, yes, so the basis of this data set. So please click on View button, and here we have actual fitted residual, the third position, actual fitted residual, and we will select actual fitted residual graph. Yes, actual fitted residual graph, where we have actual values, so empirical values of the time series, fitted values on the basis of our model, and residuals. The residual series, the residual development, or the development of error component is this blue curve, yes, and probably on the previous seminars we talked that the correct, the good model, yes, has this residual component, yes, this residual component with expected value equal to 0, yes, 0 mean, with variance which is finite and constant in time, yes, development where the values are non-correlated, no correlation in this residual component, and the distribution of these values in this residual component is normal, yes. And today we will start with heteroscedasticity, with changing of variance in time, yes, because we require, for a good model, we require the constant and finite variance in time. And the statisticians Broch and Godfrey, later Mr. Broch, Mr. Pagan and Mr. Godfrey, yes, established the version of test evaluating the heteroscedasticity or homoscedasticity of data on the basis of artificial regression. Artificial regression, which is based on the residual time series, the time series of residual component. Yes? So we have here calculated residual component, and on the basis of this data, we will create a model, the regression model, classical regression model. So please click on View button, and we have here Residual Diagnostics. Residual Diagnostics, and you can see that we have here correlogram Q statistics, where we evaluated autocorrelation. We have here histogram normality test, where we evaluated normality on the basis of Jarre-Vera test of normality, yes. And on the last position here, there is written heteroscedasticity test, yes, with 3 dots. So please click on this last option, where we have heteroscedasticity test, and there is a selection with many tests for heteroscedasticity. On the first position, you can find Broch, Pagan, Godfrey, and this is the second version of the original Broch, Godfrey Arch test, yes, which was based on evaluation of heteroscedasticity. Yes, we will not use this Broch, Pagan, Godfrey, but we will read this sentence. What is written here? Dependent variable is residuum in squares. Yes, residuum powered by 2, residuum in squares. The Broch, Pagan, Godfrey test regresses the squared residuals on the original regressors by default. Yes, this is the modification, but we will use this arc test only. Yes, we have Broch, Pagan, Godfrey, Harvey, Glaser, and there is arc test. After is test of Mr. White, yes, White. But we will use this arc test, and there is written the dependent variable is again squared residuum square. Arc test regresses the squared residuals on lagged squared residuals and constants. So this is the simplest version of our model. In our situation, artificial model, artificial regression of residuals, and we are able, this is very useful thing, that we are able to set the lock, yes. Value 1 is default, yes, we will use this basic type, basic specification with value 1, because this will be later called autoregressive conditional heteroscedasticity model with p equal to 1, arc model of the first order. So please, we can click on OK, yes, and we will see the specification of this arc test, which is also arc model, and we can call this arc model of the first order, yes. About arc model we will speak in our future slides, in our presentation. So, what's written here? Heteroscenasticity test arc. Dependent variable is residuum in squares. So we can write a in time t squared, or epsilon in time t squared, yes, or any specification, any letter for residuum in time t squared, dependent variable. Model, the regression model, we have here constant only, and residuum squared in time t minus 1. So this is really the simplest model, where we have residuum squared in time t equal to constant plus parameter alpha or beta or phi or something times residuum squared in time t minus 1. So this is practically auto-regressive model of the first order with constant. Yes, auto-regressive model of the first order is constant. You can see that everything is statistically significant, and the result is written here. The result of this test is written here. Do you remember the zero hypothesis? The zero hypothesis claims homoscedasticity. There is no heteroscedasticity. Yes? This is the zero hypothesis, which mustn't be rejected. Yes? Our wish is to not reject the zero hypothesis. We have here results here in this table, results based on Fisher statistic and chi-squared statistic. Yes? P-value is 0.01, and what it means? This means that we are below 5% significance level. So this weak model, which I showed to you, our AR model of the first order for the case of Amazon logarithms, is wrong. Because we have here heteroscedasticity. Yes, we have here heteroscedasticity. This model, which is here, this arc model, is good, and this is wrong for this situation, because this is a diagnostic tool of residuals. Yes, there is a system in residuals. There is a system in squared residuals. System in squared residuals. Squared residuals in time t, yes, depends on squared residuals in time t minus 1, and this is wrong, yes, because the residual component, yes, mustn't contain a dependence, a structure, a correlation, a heteroscedasticity, etc. A variance, yes. There is a variance, there is a system in the changing of variance in the case of residuals, yes? So now, this situation is wrong, but in the future, we will try to model, yes? For example, logarithms original logarithms, yes, the data. We will model the data by this type of model, ARC model, autoregressive conditional heteroscedasticity model, yes. And we will be happy if this model will be good, yes. Now we have good model, but on the base of residual time series, yes, which is growing. Okay, so we will return to our example from previous week where we use this model for calculation of forecast. And now you can see that our forecasted values were probably wrong because we had heteroscedasticity in our residual component. Yes, I don't remember if we evaluated autocorrelation. Yes, so here in this model we can return here to view button where we have residual diagnostics. And we have here, for example, this parallelogram Q statistics, Leung box, yes, 36, okay. Leung box Q statistics, Leung box Q test for autocorrelation. There is no autocorrelation, is the zero hypothesis. Yes, as you can see that this hypothesis is not rejected, yes, according to p-value. So there is no correlation. But there is a heteroscedasticity in the residual series, yes? So one characteristic is wrong, one characteristic is good, and we must remember on normality, yes? So one more time, please click on view button and residual diagnostics, yes, and histogram normality test, Jark-Bera test for normality, where zero hypothesis. Please zoom this window on the full size. Yes. Okay. Jark-Bera test statistic is here. 15.98, and p-value is below 5%. So there is no autocorrelation. There is heteroscedasticity, and we don't have normally distributed residual series values of the residual component, probably because we have here some outlier. Yes, maybe this and this is outlier. Yes, and because we have here higher value of Jark-Bera test statistic, which is a penalization statistic for the p-square goodness of fit test, and p-value is below 5%. So we can conclude that on the previous seminar I showed to you very weak model. Weak because we have small parameter phi of auto-regressive model. Yes, weak parameter phi where phi was equal to minus 0. Please click on view and estimation output. View estimation output minus 0.30. Yes, very weak parameter. Okay, Darwin-Watson is close to 2, and according to Leung box Q statistics, there was no autocorrelation in the residual time series, but there is a heteroscedasticity, the changing covariance, and we don't have normal distribution of the residual time series. Yes? So now you know everything. You know everything about the diagnostic of the model, and you know what is it? Autoregressive conditional heteroscedasticity. You know how to create a model because this model is already prepared in eView software, like a diagnostic tool, like a diagnostic component, yes, for the testing of heteroscedasticity. And we will use this for our future analysis and for our future models, ARC models, autoregressive conditional heteroscedasticity models. Okay, so we could see in the case of previous example the structure of Broach-Godfrey heteroscedasticity test. Yes, the model, the regression model, the formula. Yes, and now we will start to speak about ARC1 model, yes? So, ARC1 model, autoregressive conditional heteroscedasticity, model for order 1, P is equal to 1. In the parenthesis, yes, the order of ARC model is denoted by P, the same like in case of autoregressive models only. Yes, autoregressive model, AR, P in parenthesis. Yes, P is equal to some number. Yes. So now we have here the first order of ARC model. ARC1 for log returns is given as, we have here RT log returns. Log returns are equal to HT powered by 1 divided by 2 ET. Very important, this HT powered by 1 divided by 2 can be written as like square root from HT. Yes, square root from HT is the same like you will write HT powered by 1 divided by 2. Yes, two different ways to write the same thing. Yes, ET is often assumed to be Gaussian white noise with unit variance. Yes, Gaussian white noise. HT is time varying conditional variance for time t, which is given as, and there we have another formula. HT is equal to parameter omega plus alpha 1, parameter alpha 1 times r in time t minus 1 squared. Yes, log return squared in time t minus 1. Yes, I already said that omega and alpha 1 are parameters. Yeah, this is a classical model, classical regression model, where we have here this variable, this locked variable in squares. Yes, we can rewrite it and estimate it in eViews or other software. Yes, and this is very, very important. Log return in time t squared, the square value of log return in time t is equal to omega plus alpha 1 log return squared in time t minus 1 plus vt. Yes, and the model can be rewritten in the formula of AR1 model. This is very important. Autoregressive model of the first order, where P is equal to 1. Yes, for square log returns, and there we have the same formula like what the formula here on the previous slide. Yes, imagine that we don't have here the squares. Yes, RT is equal to constant intercept plus parameter phi1, yes, times my locked value in time t minus 1, yes, plus some residual error term. Yes, so this is a simple auto-regressive model of the first order, but we are analyzing everything in squares. Dependent variable is in squares, yes, and locked variable, in the case of autoregression, is in squares, yes. So, where Vt is a white noise process, yes, Vt is equal to log returns in time t squared minus Ht, yes. And we have here another exercise 29. Let us assume the following model for log returns. Yes, here we have log returns equal to HT powered by 1 divided by 2 AT. Yes, where AT is Gaussian white noise with unit variance. We already know this information. And there is a formula. HT will be equal to 0.001 plus 0.5 time squared time in time t minus 1. Yes, so one more time, ht will be equal to constant, yes, some small positive constant 0.001 plus 0.5 t squared, but t squared in time t minus 1, yes. Model dark one model in eViews or in other software. So probably we will create this process, as we will create this process, for example, in Excel. We will copy this process to eViews, and in eViews we will try to find the optimal model, and after we can run statistical evaluation, because we already know that it's necessary to evaluate the correlation, heteroscenasticity and normality of the residual component. I opened for you a Gaussian white noise process, which we already generated many weeks ago, where we try to generate autoregressive moving average models, or in general ARMA models. Yes, so we have here 500 generated values, yes, of Gaussian white noise process. Yes, we have here 500 values, and this process, these values will be used in our future calculation. Yes, according to our slide, yes, which you could see before, it's necessary to generate log returns. Yes, log returns RT, which are equal to HT powered by 1 divided by 2, so square root from HT times ET, where ET will be the value on time t of the Gaussian white noise process. But before this, we must calculate HT. Yes, HT, according to formula which was written on the previous slide, 0.01 plus 0.5 times t squared on the position t minus 1. Yes, so the first, we must start from the end. Yes, from the end. So we will create the time variable t. Yes, so here we will write t, and we will create time variable t 1, 2, 3, etc. So the last position will be 500. Yes, so there will be simple time variable t, the linear time variable t. And because we have a t, we can create here the process ht, yes, because we have written the formula, yes, we know t, and according to this formula, we can solve this. On the first position, yes, on the first position, we don't have t in time t minus 1, yes, so there will be only equal sign 0.001, yes, 0.001 only, enter. And now we have t on the position t minus 1, the previous position, so we will write here equal sign 0.001 plus 0.5 times this value powered by 2, yes, we must use hat, powered by 2, yes, and there is the second power of the previous position of the time, yes. And I hope that everything is alright. So we can click enter, and we can copy this formula to the end, yes. And there is the development of HT. And finally, we can calculate logarithms. Logarithms RT, which are calculated like HT powered by 1 divided by 2 times ET, where ET will be the value of the Gaussian white noise process on the position t. So there we have RT, and we can write here equal sign. We will use this value, we will use power function, and this will be powered by 1 divided by 2 in parentheses, yes, times, and Gaussian white noise process on time t is here. Okay, so there will be process of some log returns, yes, so you can click enter, and you can copy these values to the end, okay, and we have here log returns. These log returns will be copied to eViews software, because in eViews we would like to find the model, yes, the model of this. So we will copy these 500 values. We will use Control C button, and we will paste here values. Yes, paste values. Okay, yes, and we have here the values without formulas. Yes, paste values. We must use the shortcut Control H, find and replace. Control H, find and replace. We will find commas, and we will replace with dots. Yes. And we will click on replace all, yes, and we will see message that everything is alright. We replaced 500 values, yes, 500 values. Okay, we will return to eViews. In eViews, we will click on File button, New, and Work File. File, New, Work File, and yes, we will select dated regular frequency. The frequency will be integer date, yes, integer date, and start date will be 1, and the end will be 500. Okay, so please click on OK. Fine, and we will create here a file, yes, where we will place our values. So we will click here because we need to activate this window, and in the command log we will write a series. For example, RT, yes, like return, so RT equal to 0, yes, equal to 0, enter. And here will be a file, RT, we can open this file, we can click on edit button, plus minus, and we are able to put the values here, yes. So from our Excel Gaussian white noise, we will copy these 500 values, yes, copy, and to eViews we will paste, Control V, we'll paste these values. And now, because we have here these values, we can check in the chart, yes, in the graph view, graph, okay, we can check in graph what we created, yes, what we created. Okay. You can see that there is a development of the time series with changing volatility, with variance changing, yes, there is significant increasing of variance over time. The volatility, the fluctuation is higher and higher and higher in time, yes? So, this is a specially prepared time series, yes? And in our example, in our slide, was written that we will use this process, yes? And we will try to find a model. Our regressive conditional heteroscenasticity model, ARCH model, with parameter P equal to something, 1 probably, yes? So we will create this model in eViews, and after we will try to evaluate this model. So we will establish ARCH model, yes? So we can click on quick button. Here we have estimate equation. Yes, so estimate equation. We will zoom this. and we will write here. Our dependent variable, please move this a little bit here, because I would like to see this chart. Yes, we are modeling RT. So please write here RT hat, because this must be in squares, hat, and this is powered by 2 space. Yeah, so this will be dependent variable, log returns squared. Yes, and here we will write here RT in parenthesis -1, RT in parenthesis RT, no AR, RT in parenthesis -1 hat powered by 2. Yes, so this is a formula where we have second power of returns as entity explained by second powers as RT in one log. Yes, if you are at home, don't forget to click on options. Yes, and make sure that you have selected ordinary least squares method. Okay, so this is written. We can click on OK, and there you will see arc model of the first order. Yes, arc model of the first order, where dependent variable r in time t squared is explained by independent variable r in time t minus 1 squared, and this parameter regression coefficient is equal to 0.3257, yeah? 0.3257, and is statistically significant. We will copy Akaike, Schwarz and Hanan Quinn information criteria to prepared document in Microsoft here. Formatted copy number, as you can see, yes, copy and paste to this prepared document in Microsoft Word. Yes. So we talked about information criteria, and we have here 3 information criteria: Akaike, Schwarz and Hanan Quinn. We created arc model of the first order without constant. Yes. And we have here Akaike, Schwarz and Hanan Quinn, Criterion 25 to 75, 75, 75. Yes, almost everything is equal to 25.75. We will return to reviews, and in review software we will check the residuals. Yes, we will click on view button, and we will click on actual fitted residual and actual fitted residual graph. Yes, okay, so you can see actual values, the values which we created as in Excel, but in squares. Yes. Actual values in squares, because arc model is designed on squares. Yes, fitted values, the green curve. Yes, and the residual component, the blue one. Yes, so this is one option, and we can compare this with arc model of the first order, but it's constant. Yes, so please click on estimate. We can zoom this, yes, and between RT squared and RT minus 1 squared, we will write here C. So space C, and we will estimate arc model with intercept, with constant. Okay, so you can see that the constant, yes, the coefficient of constant is statistically significant at a 5% significance level. and the value of coefficient for this arc model as this parameter phi is lower than before. Yes, in the previous case was 0.35. Now is 0.15, 0.16. Yes. We will compare this model with the previous one on the basis of information criterion. So we have here Akaike, Schwarz and Hanan-Quinn. So we can select these criterion. We can use copy Control C, number copy method formatted, copy numbers as they appeared in table. Yes, okay. And we have here blank document of Microsoft Word. So we can paste these values here, yes? And you can see that in the previous situation, we have here these values, the values of these criterion, 25.75 approximately. Now we have 25.60 to 63. So a little bit smaller values of information criterion. So, according to statistical theory, yes, this second model is probably a little bit better. Yes, so this should be used, but we will compare the two models between them also on the basis of diagnostic tests. Yes, so now we will return to EVIUS software and we will try to diagnose if the residual component is not autocorrelated, is homoscedastic and normally distributed. I don't know, this is just experiment, but we will try to do this. So please click on view button. This is the second model, it's constant. Yes. First, we will check actual fitted residual, yes, and actual fitted residual graph. And this first, you can see the constant. We have here the constant, yes. So this is the reason why the green values are above the red values, yes. So we will continue. We will click on view button, residual diagnostics. We'll start with choreogram Q statistics where we have box Q statistics, yes. No serial correlation, yes, no serial correlation is the zero hypothesis. On the first position, this hypothesis is not rejected. There is no autocorrelation of the first order. No autocorrelation of the first order, yes, it means that maybe arc model of the first order is not enough, yes, for the description of this data set, yes? Because you can see that there is possible autocorrelation or correlation structure on the next orders, yes? Okay, we will continue. We'll continue with another diagnostic test view, residual diagnostics, and for example, histogram normality test. Histogram normality test. Okay, you can see this is not normal. This is probably log normal distribution. Yes, maybe it's because we are analyzing squares. Yes, this is the reason why we have concentrated values here, and on the right side, this is the long tail. Yes, the long tail on the top. Because of outliers, because of squares, yes, the square values which are used in our model, yes. And finally, we can check view and the test for heteroscenasticity, residual diagnostic, heteroscenasticity tests, and we will check R, yes, autoregressive conditional heteroscenasticity, and we will use here like 1, yes, okay, zero hypothesis. There is no heteroscenasticity. The residual component is homoscedastic. The result is written here according to Fisher F test and chi-square test. It's homoscedastic. As there is no heteroscedasticity because the p values are above 5% significance values. Yes, you can see that there is the similar model which we calculated in our regression as variable c and the residuum in squared in one log as independent variables, dependent variable is residuum in squared. So this is the second model, arc model of the first order with constant. Yes. There was no autocorrelation of the first order only. Yes. The residuals are not normal. This is probably logical because we are analyzing square values. Yes. So the distribution of the residuals is log normal with long tail on the top. Yes. And there is no heteroscedasticity because we use arc model, regressive conditional heteroscedasticity model. There is no heteroscedasticity, residuals are homoscedastic. So we explained the variance, yes? And this we will do one more time with the previous model, previous arc model without constant. So please, one more time, click here on estimate. And we can zoom this, yes, we can zoom this, and the C, which was written here, I deleted, yes, I deleted C, which was written here, so we have here again RT squared, explained by RT squared in the first log. So please click on OK, and here we will use evaluation, please click on View button. And Residual Diagnostic, Correlogram Q Statistics. Correlogram Q Statistics, okay. There is correlation, yes. In the previous situation where we have a constant, there was no correlation, autocorrelation of the first order. There we have a correlated residual structure, yes. So this model is really a little bit wrong, yes, more wrong. Okay, we'll continue with normality. Probably we will see again a log normal distribution with long tail. Yes? So please click on View button, Residual Diagnostics, and histogram normality test. Yes, there is one outlier here, but more outliers on the right side. 0 p-value, there is no normal distribution, yes. So probably again, log normal distribution with long tail on the top, yes. And finally, we'll check arc test for heteroscedasticity, Broch-Godfrey arc test. We will use arc, dependent variable is residuum squared. Log will be equal to 1, okay, and there is the model, and a little bit worsen values, but again, there is no heteroscedasticity. As the zero hypothesis, the residual component is homoscedastical, is not rejected at the 5% significance level, yes. So the previous model with constant, arc model with constant was probably better, but this is not the end, yes, this is not the end. We will continue with arc models in the future. Okay, ladies and gentlemen, and this is the end. This is the end of our 8th seminar. Today we talked about auto-regressive conditional heteroscedasticity, a special process, a special system for modeling volatility and evaluation of heteroscedasticity, of the changing of variance, development of changing of variance in time or in time series. Yes? So next week we will continue with this and we'll continue with other issues. So that's all for today. I wish you the nice rest of the day and I hope that I will see you next week. So that's all and bye bye.